All right, so last time we talked about a market built on discipline. Well, now we're diving into stage two, the catalyst. It is by far the shortest phase, but trust me, it's also the most explosive. This is where that slow burn suddenly ignites into a wildfire, and everything accelerates. So let's jump right in, because this right here is the absolute heart of stage two. We are about to witness a fundamental change in what credit even is. It completely stops being a tool for careful, disciplined decisions, and, well, it becomes a commodity, just another cheap thing to be bought and sold. And this slide just lays it out perfectly. In stage one, credit is like a surgeon's scalpel, right? It's used with precision, only on projects that make complete fundamental sense. But in stage two, that scalpel gets tossed aside for a fire hose, just spraying capital everywhere on everything with absolutely no discretion. This whole phenomenon is called credit commoditization. But here's the crucial thing to get. This isn't just about a central bank cutting interest rates. No, that's just the spark. The real fire is the behavioral response. It's that wave of irrational exuberance that sweeps the market, where everyone starts acting like capital is not only cheap, but infinite. And listen, this is nothing new. This isn't some 21st century invention. I mean, look back through history. Tulip mania in the 1600s, the roaring 20s that led straight into the Great Depression. These weren't just policy mistakes. At their core, they were crises of human behavior, driven by the exact same predictable, irrational reaction to easy money. The pattern just repeats itself. So what is it that actually opens these floodgates? It's not just one person flipping a switch. Let's really unpack the logic here, because on the surface it seems so seductive, but it hides a really dangerous trap.
It all starts with a pretty simple idea. That slow, real, disciplined growth we saw in stage one, well, for policymakers, it's just not fast enough. So they decide to hit the accelerator with stimulus. And at first, it looks great. It creates jobs, which seems to prove the policy is working. And that creates this dangerous feedback loop, encouraging even more borrowing and spending, all of it built on a super fragile foundation of debt.
Think back to the last stage. The math was simple. It was healthy. You only put money into projects where the return you expected to get, your ROIC, was way higher than what it cost you to borrow the money in the first place, your WACC. I mean, that's just sensible, right? Now look at how the whole picture just flips on its head. The cost of capital completely collapses. And all of a sudden, projects with awful fundamentals, projects promising a tiny 6% return, they start to look viable. Why? Because the money is just so cheap to borrow. The margin of safety is completely gone. That's the trap. And this leads to a very strange and very dangerous outcome. The rise of what we call zombie companies. These are businesses that are inefficient, they're fundamentally broken, they really should fail. But they don't. They're kept alive, just kind of shambling along, sustained only by a constant IV drip of cheap, easy money. Okay, so this brings us to what is maybe the most critical, most actionable takeaway of this entire stage. Because when the fundamentals get this warped, the whole investment game changes. A totally new strategy takes over, and you have got to see it coming. It all comes down to this. This right here is the decisive handover. The market's focus shifts. It moves away from caring about a company's intrinsic worth, its profits, its fundamentals, and it shifts toward just chasing momentum. Momentum investing is pretty much exactly what it sounds like. You buy what's going up, simply because it's going up. That fire hose of easy credit floods the system, and investors just start piling into these high-growth, speculative stocks, pushing their prices higher and higher in a self-fulfilling prophecy that's completely detached from any real underlying value. Now, you would think that a massive shift like this would be setting off alarm bells everywhere. But here's the really tricky part. One of the most common indicators that people watch goes completely quiet. It creates this dangerous smokescreen. So what's this deceptive indicator? It's the index to commodity ratio. This normally helps us compare the speculative growth in stocks to the real-world growth of commodities. But during this whole frantic shift from value to momentum, this ratio, it does nothing. It just stays flat or bounces around a little, showing no clear trend at all. It just goes silent. And this is the great deception. So what's actually happening under the surface? Well, the steady, real growth that we see in commodities is being perfectly matched by this new flood of wild, speculative capital pouring into the index. It creates a perfect illusion of stability, and it completely masks the fact that the quality of that growth has become dangerously, dangerously fragile. So let's wrap up stage 2. The real catalyst isn't a policy decision, it's the behavioral shift that comes after. All that cheap credit keeps those weak zombie companies shambling along. But the most important thing for you to watch for, the real leading indicator, is that factor shift. When you see the market pivot from value to momentum, you know the game has changed, even if the other ratios are telling you that everything's fine. And that's really the question to leave you with. When all the obvious signals are giving you this false sense of security, you have to know where else to look. Because understanding this hidden handover from value to momentum, that's the absolute key to seeing stage 2 for what it really is, the calm before the storm.